All right. Hello, friends. I'm coming at you from a kind of a different angle in this video because we are going to need you to get out your book and follow along with us when we're making this presentation to you. And really, what we want to talk about is how banks create money. Now, the reason that we want to talk about how banks create money is because we are talking about monetary policy. And if you remember from our last conversation in our last video, we said that monetary policy is ultimately the manipulation of the money supply by the Federal Reserve System, the Fed, in order to adjust aggregate demand so as to address a particular economic outcome. In other words, monetary policy is a way of adjusting aggregate demand, just like fiscal policy was a way of adjusting aggregate demand. So, if we have a recession and aggregate demand is too low, one of the things that we can do is fiscal policy and expansionary fiscal policy, as we discussed, right? Whether it's increasing government spending or reducing taxes, either one of those or a combination thereof would be an appropriate expansionary fiscal policy. Monetary policy would involve adjusting the money supply to accomplish the same ends, right? To increase aggregate demand. So monetary policy involves altering the money supply to alter aggregate demand to achieve some economic outcome. Now, we said the first step in understanding monetary policy was to understand money. What is money? What's money in the U.S. economy? And in chapter 31 in your textbook, which I imagine that you read quite carefully, you understood that money has various, functions, and whatever fills those functions is money, right? And we said in the United States, money is defined as currency in circulation, all currency in circulation, paper money, coins, etc., in circulation, plus all values in demand deposit accounts, checkable accounts. The reason that that's money is because those two things have immediate liquidity. Liquidity is the closeness something is to a medium of exchange. So if something is liquid, it can be used as a medium of exchange. And currency and, in fact, checkable deposits can be used immediately as a medium of exchange. So M1 is most liquid. It's a medium of exchange. And so the value of M1 is the money supply. And ultimately, altering that value is what monetary policy is. So the next question is, who does it? And the answer is the Federal Reserve. And in chapter 31, there is an extensive discussion of the structure and the history of the Federal Reserve, which you read and understood completely. And I'm sure Mr. Spinola will give you assignments and you'll answer questions about those things. But the most important thing the Fed does is it controls the money supply, monetary policy, the open market committee of the Federal Reserve, which is made up of the 7 members of the Board of Governors and 5 bank presidents on a rotating basis, with the exception of the president of the Federal Reserve Bank of New York, who is always a member of the open market committee. Those 12 members decide what we call monetary policy, right? That's the big function of the Fed. Well, the question then becomes, how do they do that? I mean, how do you increase the money supply? I mean, do you just print out more money? Is that how they do it? Just, printing out more money? And we said, no, that's not actually how they do it. The Fed controls the money supply by making it either easier or harder for banks to create money. Oh, kind instructor, you say that banks can create money. Can they print money? Well, not really, but banks in fact can create money. And the Fed controls that process or influences that process, and by doing so, they control the money supply. So, if we want to understand how the Fed does it, we have to understand how banks create money. Now, we introduced this notion, which is the first part of chapter 32 in your textbook, by talking about something called gold warehousemen, right? And we talked about medieval Europe and how gold warehousemen would collect gold, and then they would issue certificates, and those certificates circulated as paper money, and then they started to make loans, which were additional certificates that really weren't backed by anyone's gold in particular, but backed by the fact that everyone knew that the certificates were worth their value in gold, their weight in gold, so no one came to really cash them in at any given time, and so banks could make loans and therefore create money. And that is discussed, and what you should do is stop this video and go get your book, right? Go get your book, your textbook, and turn in your textbook. Pardon these glasses, I know they look dumb. Give you something to look forward to. I could see perfectly until I was 45 years old. So I'll give you something to look forward to in later in life. But on page 646 in your textbook, there is a discussion there of the goldsmiths and the gold warehousemen, and this whole notion of what we call the fractional reserve system of banking. And the fractional reserve system of banking, and again, that's on page 646, and you should get your book out and turn to that page, because I'm going to make reference to some illustrations here to sort of explain it to you. It starts with that conversation about the goldsmiths and how they kind of pioneered the fractional reserve system of banking, which is still implemented to this day. And it is the Fed that influences that system is how they control the money supply. Now, to illustrate that and how banks work and how they create money, let's start, as they do on page 647 in your textbook, with a single commercial bank, one bank. And let's say that we were going to start a bank from scratch as a way of illustrating how the Fed could influence that one bank's ability to create money. Now, if you look on page 647, it introduces something that's important in understanding money creation, and that's the balance sheet, right? And you can see there that the balance sheet is a statement of assets and claims against those assets, which we call liability and net worth. And you can see on the right side of the page, there is an example of a balance sheet one. On the left, you see assets, and on the right, you see liability and net worth. Now, let's talk about assets and liability for a moment. An asset is anything that any entity has, whether it's a bank or an individual or any kind of company, or even the government or a nonprofit or any entity that has some value, right? So an example of an asset would be cash, right? If an entity, if you as an individual had $10,000 in cash, you would say part of your assets include cash. Well, that cash has a value. Now, cash isn't the only asset. You could own real estate, right? You could own a piece of property that is valued at $10,000. That's also an asset, right? You could have an automobile that's valued at $10,000. That's also an asset. A company could have lots of equipment that has value. That's an asset. They could have inventory that has value. That's an asset. Individuals could own stock in other companies that are assets. Anything that has worth is an asset. And on a balance sheet, all the assets an entity have, whether it be an individual, whether it be a company, whether it be a government, any kind of organization, all the assets are listed on the left side, right? These are all the things that entity, that the value of all the things that entity has that have worth, right? Assets. On the right side of the balance sheet is liabilities. And liabilities are claims against that assets. Now, there's the liabilities, it says liabilities and net worth, plus net worth. Now, when we talk about a claim against an asset, the simplest way to do that is, let's say that you owned a house, right? Like your parents own a house. And they have a mortgage on that house, right? So the house that you live in, the Monroeville people, you live in, like, I don't know, $300,000-$400,000 house. Those of you from Pitcairn, not as much. Like you and I, not clearly enough. Mr. Spinola, probably $500,000 house, something like that. Let's use Mr. Spinola in Murraysville. Clearly, he has a very expensive house, maybe $500,000, let's say. So we put on the assets for Mr. Spinola, $500,000. House is worth $500,000, right? Is there a mortgage on the house? Does he owe anything on the house? Yes. He owes $200,000 in a mortgage. Well, that $200,000 debt that he owes is a liability. And that mortgage company, that bank, has a claim against that asset, right, of $200,000. Now, what about the rest, the $300,000? That's net worth. Mr. Spinola has that claim. So every asset, the entire value of assets, there are claims against them. Some of the claims are someone other than the entity, right? Other than you, if this is your balance sheet. Things that you owe, but what's left is your net worth, and that's your claims on the asset. And in essence, that's how we figure out if people are rich. You know, if you want to know if somebody is rich, you know, what they're valued at, you look at their net worth. That means you look at all their assets, and you subtract all their liabilities, the claims that others have against their assets, and what they're left with is their net worth, and their net worth is, in essence, their riches. So somebody rich like Jeff Bezos, you know, with Amazon, you know, they say he's valued at, you know, so many $1 billion. What does that mean? Well, you know, you look at his assets, and probably a fair amount of his assets are stock in Amazon, right? You know, he might have other assets. He might own other companies. He might have other things. He might have property. He might have, we list all his assets together, and they're billions of dollars. And then his liabilities, the claims against those assets by other entities, banks, and other things. And what he is left with is his net worth, which is probably still billions of dollars. And therefore, he's rich. Well, same with Mr. Spinola, right? He has all these assets. He has the liabilities, claims against him. What he's left with is his net worth, which is his claims against the assets. And if he has a significant amount, then, you know, we say he's well-to-do, right? So when we look at any kind of entity, whether an individual or whether it's a company or a government, they list their assets and their liabilities, and what they're left with after they subtract liabilities from assets is net worth. Right? And you see that on these illustrations here. So let's go to this, and let's start with transaction 1. And transaction 1, we are starting a bank from scratch, right? And so what happens is, you know, we as a bank, you know, starting this company, solicit investors into the bank, right? And in return for their investment, we give them a share of ownership for the bank. So let's say a number of people say, oh, yes, we'd like to start this bank. Here's $10,000 or $20,000. And we say, oh, okay, in return for that $20,000, we are going to give you shares of ownership in this bank, right? Stock shares. So you're going to own so much stock. Now, if we look at the balance sheet 1, you could see the cash we collect for our bank is an asset for the bank. The stock shares that we create are a liability for the bank. It's a claim on our assets by the owners of that bank, right? Liabilities always have to equal assets. They always have to equal, with the difference being net worth, which makes them equal. And net worth is a liability too, right? So now let's look at, and you can see that, take a look at balance sheet 1, top of the page, 647. You can see we collected $250,000 in cash, and that's an asset. And the claims on that asset are $250,000 in stock that the ownership has. And so liabilities equal assets. Now let's go to transition 2, acquiring property and equipment. So look down at the balance sheet 2 there. And what you can see is that what we've done is we've taken $250,000 of our cash and bought property to start a bank, whether a building and all the equipment and everything that we need. And notice here that there's no change in the stock shares because all we did was transfer cash assets to another asset. I mean, that's something that's true. If you buy something of worth, you still have it. Right? If you had $500,000 and you went out and bought a $500,000 piece of property, you still have $500,000. It's just stored in another form, rather than cash. It's stored as an asset, as a real estate asset, right? So we bought this property, we got our bank all together. We're going to open up our bank, for business, right? So look, nothing has changed. We still have $250,000 in asset in the balance sheet too, and $250,000 in liability stock shares. But now we open the bank up and customers come flocking into our bank and they deposit money in checking accounts. And let's, for simplicity, say that's all we have is checking accounts. They deposit money in checking accounts. Oh, okay, we see there that they deposit $100,000 in checking accounts. And let's say, for the sake of simplicity, that they deposit cash. They bring in money and deposit cash. Now, I'm going to note something here. When they do that, the money supply, as we know it, does not change, because currency in circulation is part of the money supply, M1, and checkable deposits are part of the money supply, M1. So if I take $100, right, and I go to the bank and open a checking account and deposit that $100, I convert that currency, which is part of M1, into check money, which is a part of M1, but the total amount of M1 hasn't changed. So $100,000 worth of demand deposits have been deposited into this. The money supply has not changed, right? And now the bank has an additional $100,000 in cash, and it's got new liabilities. The checking accounts are liabilities because anybody could come and write a check and the bank will have to pay it. So each of those people that have a checking account have a claim on that cash, right? So now, if we look at accepting deposits, balance sheet 3, we have $350,000 in liability and $350,000 in assets, $110,000 in cash assets. And we have numerous people that have opened a checking account. Now, here's what we notice. We notice, if we're functioning as a bank, and all these people have checking accounts, that the value in that checking account and the value in our cash assets doesn't change that much day to day. Even though everybody could pull all that money out at once, they don't. Some people write checks and they're cashed by other people who also have accounts in that bank, right? So we kind of notice that in normal activity, the amount of cash we would need to support those liabilities, those check deposits, is not 100%. Because at any given time, the entirety of our customers are not coming to take all their money out at once, right? There are normal and usual transactions. Let's turn the page, right? Now, we turn the page, we go to transaction number 4. Right, with transaction number 4 is described on page 648, but it is not illustrated until 649. And what's going to happen there is we're going to take our entire $110,000 in cash and deposit it with the Fed, right? And that's what banks do. Banks have checking accounts too. And those checking accounts they have are at the Fed. So just like you might have cash and put some in a checking account, the bank has cash and they put some in the checking account. Now, obviously, all banks have some level of cash, right? That they're going to meet the demands they need in day to day with that cash. But they don't actually have as much as you might think. Because really, in a day, people deposit cash, people withdraw cash. It kind of equals out. Right? So they don't need much vault cash at the end of the day to support what their liabilities are, So most of their most of the cash that they receive, they deposit at the Fed, right? And so in this case, we're going to deposit all of it at the Fed in a checking account that bank has. And notice nothing has changed. We still have $350. Now, we're going to skip transaction 5, right, in your textbook on page 649, and we're going to go to transaction 6, right? Because now what we're going to discover is we're going to say, well, look, we've got all this money in the Fed, and the Fed is, we have there, and people are coming and taking money, putting money in, taking it out. But we notice we don't have to hold 100% of our liabilities on hand at the Fed to meet them, right? and I'm making this fast because transaction 5 would make this clear, and you can read that. But what we're going to do now is take a chance. We're going to make a loan, right? We're going to make a loan of $50,000. Now, when we make a loan of $50,000, in essence, what we're going to do is create a demand deposit account, create a checking account, or create a check. And in doing so, what we in essence do is create money. So look at transaction 6A on page 651, right? In transaction 6A on page 651, right? There's $100,000 in checking accounts, right? There's $100,000 in checking accounts and $50,000 in a loan, right? So when that $50,000 loan is created, then the value of the money supply goes up by $50,000, right? Because you created a check for $50,000. So let's say they did this. Let's say the bank created a loan. Let's say there was $100,000 in checking accounts, and the bank makes a loan to one of the people that have that checking account, and they deposit that $50,000 in that person's checking account. Well, what would happen? Right? What would happen is that person's checking account would go up $50,000. And in essence, when that happened, the money supply would go up by $50,000. Now, that person would inevitably spend that money, and it would be deposited in another bank, and through the Federal Reserve, that bank would get that money that's in our bank's Federal Reserve account in their bank's Federal Reserve account, and then, right, and then that the $50,000 money creation, the $50,000 will go out there, and it will look like balance sheet 6A, with loans being $50,000 and reserves now at $60,000. So what in essence the bank does is convert some of their reserves into loans. And when they convert their reserves into loans, they are basically converting their reserves into additional money, right? Anytime a bank makes a loan, they are creating money. That's new money. Now you might say, no, it's not, kind instructor. You're crazy. It's not new money. You are loaning out the money of the people who have their money in the bank. No, you're not. Because all those people still have that money. Right? You never go to the bank and try to take your money out and they say, well, sorry, we can't give it to you because we loaned this out to somebody else. No, no, no. All those people still have the money, but this person that got the loan has the money. So everybody has the money. Now, everybody has the money, and the money is out there circulating as long as everybody doesn't come to the bank at the same time and take their money out. If they do, it's not there, right? Because the bank is only holding a fraction of those reserves on hand. It's called the fractional reserve system of banking. And when banks make loans, they create money. And the Federal Reserve controls how banks make loans. More about that in the next video.